so that's fine. Okay, opening question for Carl this time. Income securities have been weak over the last 6 months, and some of the newer hybrids are now trading well below their issue price. Can you please explain some of the reasons for this?
Thank you. Start with slide 2. Cash rates have been stable and falling across the globe over the last 12 months. Corporate yields have risen low, and that explains why some of these hybrids have unfolded in price. These hybrids are priced over the bank bill rate. So in Australia, our bank bill rate's been steady at around about 2% or 2.1, 2.2, but investors are demanding a much higher return now. And in this example I've got up here is Commonwealth Bank PD. It's their fourth preference share that they've recently issued. It's a Basel III preference share, which means that it can be forcibly converted into shares depending on their capital adequacy ratio or depending whether APRA believes they need extra capital and APRA can demand it be converted. Therefore, it is really a hybrid and not a bond, and it has quite a bit of equity in that particular security. And Commonwealth Bank is arguably one of the safest banks, one of the safest stocks on the ASX, yet the hybrid over the last 12 months has fallen up to 13%. Now it's recovered a little bit in the last week or so, but you can see that you can lose money effectively. What most people think is just lending money to a bank because of that equity component in it. Now, why have bond yields risen? Why have corporate yields risen? Bond yields have risen a little bit as well, but it's mostly been the margin. And the reason is that the risk appetite has sort of waned a bit. And you can see the equity market has fallen quite a bit in the last 6 months as some people have reassessed the future. And particularly banks, as Mark has said, banks have fallen even harder than the general equity market. And as you know, CBA is a bank. There's also been the uncertainty of China, the potential US cash rate increase, and also very sluggish global growth in the last 6 months. And that has made the corporate bond market a bit more skittish. This particular security, like all those Basel III securities, the maximum return you can get on this particular security is the margin above the bank bill rate. So at the moment it's about 4.8%. But the downside is almost unlimited or almost 100%. So I think Barry's done the right thing in not recommending these newer type securities to the portfolios you've got, because there's a limited amount of upside, a little bit more than a normal bond, but not that much more. Well, particularly last year it was issued only at 2.8%. Now it's a bit more attractive, yet you've got quite a bit of downside, and the market has reassessed that particular downside risk. I also want to just talk about one other one, Macquarie Bank, HB. Go back to slide 1. Now this one's an interesting one. I know a lot of you have got Macquarie Bank, HB in your portfolios. As you can see there, prior to the GFC, it's been trading just above 100. You know, it's a perpetual security, so it's got no maturity date. It's got a low coupon, but back then corporate bond margins were quite low, particularly for a high quality bank like Macquarie Bank. Then the GFC came, and after being so steady, for even prior to that, for the 10 years prior to that, whooshka, it just falls off a cliff and it goes down to $31. So this is a bond that people were expecting, just trades around 100 and a bit above 100 at a premium. Within the space of 12 months there, it falls 70%. Now, if you would have bought it at $31, you would have got a fantastic capital gain, plus probably 15% running yield along the way. That would have been a fantastic time to buy. The market rounded up quite hard once people realised that the war wasn't going to finish, and it got back to $80 quite quickly. But it's been in a range in the last 5 years, and got down in 2012 to $60 again, back up to $90, and now it's come off again, just like the other hybrids have. Now this one has got a very low coupon, 1.7% above bank bill. All the newer ones are like 3%, 4%. So because it's got a low coupon, to get a high return, you need to buy at a lower price. And normally, hybrids aren't sensitive to cash rates because they're normally traded around 100, so their margin is whatever the coupon is. But in this case, Macquarie Bank trades well above its coupon. The margin is about 3.5%, coupon is 1.7%. That's above the bank bill rate. So as cash rates have fallen, and there's an expectation that they may fall again, that particular security has seen it fall now in the last 12 months. Quite a significant fall, about 25%. Is $70 a good level? There could be another cash rate fall. I mean, I think the very view that there probably won't be, but there may be another cut or two, and the market, I think, is saying that there's a risk that there may well be. And therefore, for this security to maintain that traded margin, it will need to fall a bit more. Plus, if you get another blowout in corporate bond yields, that will fall as well. And because it's a perpetual security, a 1% fall in the, sorry, a 1% rise in the yield equates to about a 13% fall in the actual price, the dollar price of the security. So it could fall back to that $60 level again, which I think would be excellent buying. Because if the cash rate is cut one or two more times, surely we are very, very close then to the end of the interest rate cycle if we're not already at the end of it now. And there's another incentive for Macquarie Bank, and this also is relevant for NAB-HA. Some of you may also have NAB-HA, very similar security. The other incentive is that because it is an old style security, APRA are progressively not allowing this bond as part of their Tier 1 capital. So if each year passes, 10% less goes into their Tier 1 capital. At the moment it's about 70%, next year it'll be 60, then 50, and in 7 years' time with 0% of this security. We're just like holding debt or a term deposit for them. So therefore they need to raise additional other capital. So it's inefficient to have it on there. And then in addition to that, we've also heard that they've stuffed up the particular accounting or the tax treatment of it, and the tax office will now stop allowing them a tax deduction for the interest component of this particular bond. Now, I haven't heard that from them directly, but from quite reliable sources we've heard that. So that's another incentive that Macquarie Bank have got to repay this one. So I believe they're looking at it at the moment just like NAB, because the NAB one's also come off. So maybe buy a little bit now, but in the low 60s, I think that will be really, really good buying for this particular security if it were to get there, or if we can be confident that that the equity market is consolidating again, and there'll be no more cuts in cash rates. That security can go back to 80. And they probably won't buy back at 100. What they'll probably do, which is what Suncorp did last year with their perpetual security, and put a buyback. Maybe if it got to 65, they may price the buyback at 75 to 80 and get as much as they can off the market. Then eventually, people who hold out forever, you'll eventually get $100 if you, but that may be for a while. So, because they can only offer to buy them off you at any price, but you have to sell it to them at 100. I mean, that's a long way away from 70, so I doubt they'll do that straight away.
Thanks, Carl. Would anyone like to ask Carl a question about income securities at this point? No? Okay. Okay, so an opening question